Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Despite the ongoing challenge of COVID, 2021 has been a highly successful year for investment companies, with the average investment company up 13% during the 11 months to end of November. It's been a record year for fundraising, with the industry raising over 13 billion compared to previous high of just over 10 billion in 2014. The industry's assets are also at an all-time high of 274 billion this year. To put that in context, assets have increased nearly fivefold since I joined the industry 24 years ago. So there's plenty for investment company investors to celebrate. To discuss the past year and the outlook for the year ahead, I'm delighted to be joined by Paul Niven, Manager of F&C Investment Trust, Lee Chen, Co-Manager of Keystone Positive Change, and Devise Williams, Co-Manager of Diverse Income Trust. Right, on to the questions. What do you see as the greatest causes for optimism and concern in 2022? And I'd like to ask that question to Paul.
Well, optimism is based upon what I think could be quite a robust growth environment where the global economy has another year of above trend growth, where we return to a more normal environment, with COVID having less impact on all of our lives as a function of the successful vaccination programs and antibodies in the community. The optimistic scenario is also one where inflation proves to be transitory and recedes as supply issues are resolved, and where central banks are cautious in tightening policy. And that means that bond markets could remain well behaved. In that environment where markets don't get spooked by policymakers and where earnings continue to grow at a double-digit rate, it's relatively constructive for equities. But what can go wrong? Well, as usual, many things, but largely it'll be, I think, due to lower growth or higher inflation and interest rates. Lower growth is a function of government restrictions or a drop in consumer and business confidence, most likely COVID related. And higher inflation looks stickier than had previously been assumed, and that will likely pressure policymakers to tighten liquidity and interest rates, and that could upset equity markets. But on balance, though, I remain optimistic.
Well, that's good, Paul. Devise, what are your greatest causes for optimism and concern next year?
Yeah, what has been interesting is when I'm talking to companies at the moment, I'm seeing an awful lot of companies which are seeing real pressures on wages. But they're really seeing the recruitment is difficult. They're losing some of their current staff. And I think this could be something which actually persists for some time and actually leads not just to extra costs, but actually companies coming under profitability pressure. And it could be that markets are unsettled from that point of view. One of the features of the year, though, could be that actually we start to see the pattern of the market changing. Some of those with the most negative cash flow, some of the unicorns perhaps, which have grown so much over recent years, may find their share prices not doing quite so well. And companies with really safe businesses generating plentiful surplus cash, companies possibly generating a surplus cash and paying dividend yields, could actually see the opportunity to take advantage of the weakness of others and improve. So I think actually the UK market might be well positioned to outperform others going forward.
Yes, Devise, I've just been recruiting and I found it really difficult, but I have made an offer for someone now. Lee, what are your greatest causes for optimism and concern next year?
Well, I think for us, thinking not only about next year, but the coming decades, we are excited by the opportunity to move towards a more sustainable and inclusive future. We think that trend will affect all industries and leads to opportunities for innovative companies that are coming up with products and services that are better for society, better for the environment, and can generate shareholder value as well. So we are excited to find innovative company in those areas. In terms of concerns, of course, there's still ongoing concern about supply chain and potential new COVID variants or COVID restrictions. But we think those are short-term. Over a much longer time period, over a 5 to 10 year time period, we are excited by the opportunity for innovation to create a more sustainable future.
Well, I really hope you're right, Lee, that those concerns about COVID are over the short term. I'm going to ask, how are you tackling the rising concern over the Omicron variant in your portfolio? I'm going to ask that question to Gervais.
Yeah, I mean, we'll have to see. I mean, if it's not Omicron, maybe it'll be some other variant. I think we are going to see more variants. This isn't just a one-off. Clearly, asset prices are well positioned. They've done very well over recent years, but perhaps they're vulnerable to downside. So one of the features we can do as a fund is to buy some stock market insurance. They're called put options, FTSE 100 put options, and they're in place such that if we do see a setback in stock markets because things get much worse than we currently assume, then of course the opportunity is for these assets to actually improve and provide a good cushion for the market setback. We had one last year actually in March 2020, and that actually led to not just a generation of extra cash at a time when the market was going down, but the ability to sell that put option, take the profits, bring the cash into the portfolio and buy more income shares at a time when they were distressed in valuation and set for a strong recovery. So that's what we've done at the moment. What we're really focusing in on, though, is on companies which are able to sustain good and growing income, generate plenty of surplus, irrespective of whether the markets are good or bad.
Thanks very much, Gervase. Lee, how are you tackling concern over Omicron variants?
So for us, we are looking for the solution providers in the COVID pandemic. So one of the largest investments for Keystone Positive Change is Moderna, which creates the vaccine for COVID. We invested in a company since the IPO, and we believe that its mRNA technology could have broader application, not just for new COVID variants, but increasingly to different therapeutic areas. So we're looking directly for companies that can make a positive contribution to our ability to tackle new COVID variants. And we look for businesses that can help us continue our way of life, even with ongoing restrictions. So thinking about telehealth providers that allow people to continue get healthcare services even from their home. So those are the businesses which will continue to help us to live with COVID.
Yeah, I think you're right there. And Paul, how are you tackling rising concern over Omicron in your portfolio?
So as of today, we just don't have enough information really to make a properly informed decision. And that said, early indications are for higher infection rates, perhaps less severe illness, and views on vaccine effectiveness are clearly mixed. I think personally it's too early to conclude that Omicron is a game changer, but it undoubtedly creates more uncertainty, two-way uncertainty, I would argue, and that adds volatility. What I do think is it delays rate hikes and tightening due to the more uncertain backdrop and growth, but also at the margin could add some inflationary pressures if we see some more supply chain disruption. I think it is worth stating there is a bullish scenario from this or potentially other variants where they're actually more infectious, but maybe less severe. And that could crowd out the more dominant Delta variant, which is dominant globally today, without increasing mortality, in fact, decreasing mortality rates. There is some hope for this outcome, as in general terms, viruses may become less potent as they mutate, but that's really conjecture at this stage. What I would say is that government policy will primarily be driven by mortality risk, and we just don't know the situation there yet. So no fundamental change in view from the Omicron variant at present.
Yeah, too early to tell, but fingers crossed that it's not too bad. Lee, COP26 was a catalyst for the consideration of ESG issues. With this in mind, how are you addressing sustainability in your portfolio?
So for the Keystone Positive Change, our ambition is to invest in really innovative businesses that are coming up with solutions towards sustainability challenges. So for us, sustainability is absolutely the center of what we do. In fact, we have a dual objective that every company we invest in must have the potential to generate attractive long-term investment return and also have a positive impact. So we're actively looking for businesses where they are helping to improve the challenges in areas like climate change or healthcare pandemic, as the case of Moderna, or access to information, education, and basic services.
Yeah, and Paul, COP26, clearly a catalyst for all things ESG. How are you addressing sustainability?
Well, ESG considerations more broadly are embedded in our underlying stock selection processes. We have a limited number of exclusions, areas we won't invest, like tobacco, thermal coal, controversial weapons. But in general, we have the view that engagement is more effective than exclusion, and simply withholding capital from certain areas does little in the real world to affect change. So on engagement, we've got a large and dedicated team who engage on our behalf across holdings. We track progress of that engagement with companies in a wide number of areas. Just as an example, during 2020, we engaged with almost 150 companies, which we held across almost 30 countries, raising over 600 issues on labour standards, corporate governance, and so on. We've also allocated capital to specific sustainable strategy on our portfolio, and that invests specifically in companies which rank very highly on sustainability criteria. One example of that, Smurfit Kappa Group, whose whole products are focused on paper-based packaging as a substitute for plastics, thereby reducing the impact on biodiversity, both oceanic and land-based. And as a trust, I think it's very important to point out we have made a commitment to net zero on our portfolio by 2050 at the latest, and we've developed a roadmap in order to achieve that goal. And that board commitment to net zero carbon emissions by 2050 is a very significant step for the company, and it's in line with obviously many governments and an increasing number of companies. And through engagement practices, we'll seek to hold companies to account for their commitments that they've made, and ensure they've got a clear, credible pathway on an interim and long-term basis towards that net zero target.
Thanks very much, Paul. I think it's really important that you've clarified what engagement means and actually given the number and the examples, because that's one of the things that investors always ask us about, what engagement exactly means. Gervais, COP26, clearly a catalyst for ESG issues. How are you addressing sustainability?
What's interesting about sustainability in terms of the UK fund management sector is that we're quite experienced at engaging with businesses. As you know, ever since the Cadbury report, businesses, the UK fund management sector has been quite active in engaging with quoted companies, and that's led to improving safety standards, obviously improved board governance. And I think climate change is just another form of engagement. And I think the UK fund management sector stands ahead of others regarding that. Going forward, of course, it's not just about some of the companies which are already meeting the 1.5 degree climate change, but actually we've got to think about the companies which aren't doing so, but need heavy investment. The financial sector has a big responsibility to find ways to reduce the carbon emissions to do with steel and cement, just as it is with all the other businesses in which we engage in. And I think there will be opportunities, because they will need to invest substantial amounts of capital. They will produce, obviously, improved outcomes in terms of emission standards. But most particularly, I would argue that actually these companies, if they move ahead of others, will be able to take more advantage of the changing market, because customers and particularly governments will want to deal with those which are already changing. So I think as a sector, the fund management sector, the UK fund management sectors are probably ahead of most others in this engagement.
Well, that's good to hear, Gervais. Paul, what is your approach to rising inflation in your portfolio management? And how do you see inflation affecting income over the next 5 years?
Well, in terms of inflation, there's obviously a huge question over where we go to from here. Headline and core rates have risen very markedly. There's signs of wage pressures building, more widespread pressure on inflation. That may well persist after some of these short-term bottlenecks, supply chain issues have been alleviated. But my view is that inflationary pressures will prove to be more transitory than we and others, I think, had initially hoped. But you need to put that in context. Inflation will still remain low by historic standards, but certainly higher, I think, than where we were pre-pandemic. And that means that liquidity and interest rates liquidity will be tightened, rates will rise next year. And equities in general terms should provide some protection against inflation, because companies can, in many instances, pass on price rises in their inputs to consumers in many cases. And that's especially true when inflation rises are relatively modest, as I expect. Within the market, certain areas like commodities, financials may perform better in an environment of good growth and rising rates. And we've tilted our allocation towards those areas by allocating more capital to those and higher yielding stocks and value in general. And we've leveled up exposure between growth and value. So we reduced exposure to some of the more expensive areas of the market, which had largely led the way in recent years. They may be a bit vulnerable to rising interest rates, and with more growth globally, that premium valuation may erode. I do expect that not only earnings will recover at a decent double-digit rate in 2022, but dividends will also continue to recover relatively strongly for the trust. We've got a 50-year track record of raising dividends year in, year out, and it clearly remains the intention of the board to extend that record further from here. And I think it'll take a few years, frankly, to get back to a position of having a covered dividend on the trust. But the gap I expect to narrow, and we've got substantial revenue reserves which can dip into to maintain our record, not only of paying, but raising dividends for shareholders.
I absolutely agree, Paul. I mean, obviously, investment companies have a special advantage when it comes to paying income. And we have 18 companies that have increased their dividend every year for over 20 years, and 6 that have over 50-year track record, and F&C Investment Trust is one of them. Gervais, what are the specific advantages in investing in the UK over other developed markets, such as the US, for example?
What's interesting about the UK market, it clearly has underperformed over recent years. But of course, in a way, part of that performance is due to the different heritage. We have a heritage really of having companies maybe slightly growing, but they generate surplus cash. And in generating surplus cash, they then either pay dividends or reinvest in acquisitions and other features of growth. So actually, what could happen is we could see a rebalancing of portfolios away from strategies which have performed so well over recent years, these with sort of very rapid growth prospects, perhaps absorbing cash, perhaps like some of the US stock markets, but others as well in the world, perhaps including companies which are less volatile, what's called low beta. And in that regard, they don't tend to zig and zag so much, but they tend to do much more resiliently at times of uncertainty. They've got surplus cash, they don't go bust so easily. And if there are companies which do go into insolvency, then of course they're businesses which can be acquired and hopefully retain that employment, but most particularly make an enhanced cash return on that. The UK has actually had a history of outperforming during more difficult times. Back in the 70s and the early 80s, when a lot of companies went bust, actually the UK was one of the best performing stock markets, way better than the US stock market. So I think there's plenty to look forward to in the UK. The second feature is just to touch on is there's a wide range of market capitalizations. There's some main and mid caps, there's some small micro caps. Again, smallness, I think, has the advantage when things are uncertain. They're nimble, they're able to acquire assets from a receiver and make enhanced returns. I think the UK could be well positioned to do something very different from most other stock markets in the world.
Well, let's hope you're right. Lee, how do you expect sustainable investing to look in 10 years? Got the huge appeal of ESG investing recently. Are all funds going to become ESG focused?
I really hope so. And I think more and more funds will incorporate ESG into that process and think about sustainability issues in their investing. And I think that is a responsibility of the asset management industry going forward, to make sure that financial capital can be used productively for society broadly. There will be different ways of sustainable investing. There'll be engagement, there'll be exclusion-based strategy, and there'll be a positive approach like what we're trying to do with Keystone. And the right approach will be depending on the right client and the right fund manager. For us at Baillie Gifford, we think our competitive advantage is being able to invest long-term and look for genuine disruptive companies that are coming up with exciting innovations. So on that front, we are really excited to leverage on Keystone, on the closed-ended structure of investment trust to allow us to invest in private companies, provide primary capital directly towards businesses to help them scale innovation that will be for a better future.
Well, that's good. I'm hoping that investment company structure with its long-term permanent capital will help you do that. Now I'd like to ask all of you, considering your investment company in 2021, what were you particularly pleased about? And I'm going to ask that question first to Gervais.
Yeah, so I mean, what was interesting is we had a period when there was numerous dividend cuts, obviously very plentiful dividend cuts in the UK as well as other regions around the world, and that was disappointing. And what was reassuring is that many of our companies restored their dividends, and in some cases they've gone on to grow them. So the overall revenue account in the businesses in the trust have actually now recovered pretty much to back where it was back in 2019. So although other companies around the world are still nursing dividend cuts, We're in a fund which has actually restored income, continued to grow its dividend to share to investors over the last 2 years, as it has in previous years, but most particularly is now in a strong position with strong revenues, even after an unsettled market period.
Well, that's great news for shareholders. Paul, what were you particularly pleased about in 2021 for F&C Investment Trust?
Well, it's been a good year for shareholders so far, with strong gains in net asset value and our share price. So that, in general terms, is pleasing in performance terms. And strongest performance has generally come from our US exposure, US stocks in the listed space, where we've got around half of our portfolio. But actually, it's been our unlisted holdings in private equity space that have performed strongest year to date. And in recent years, we've made substantial commitments, and we've seen material uplifts, which led to those returns in the private space outstripping those in listed markets. And we're actually also seeing realizations on a number of our more recent commitments. And one example of that was an investment we made back in early 2018, a co-investment into a private company called Pet Network, basically a pet supply retailer based in Southern Europe, Croatia. They grew organically and through acquisition, and we sold that earlier this year for a gain of 4 times our initial investment. So it's really pleasing to see that private equity program progressing well, and also to see very good returns on our recent commitments.
Absolutely. It's been a great year for private equity investment companies and companies in the growth capital sector. And I have to say, I'm very interested to hear about your company focused on pets, because a trend of lockdown, which I have to be honest, our family has actually followed, so that we now have a kitten and a puppy as new members of the family. So I'm not surprised the pet company did very well. And Lee, I'd like to ask you, how about your company in 2021? What were you particularly pleased about?
So 2021 is the first year that we took on the management for Keystone Positive Change. There are a number of things that we are excited and we're very happy with, but we are even more happy with what the company that we have invested achieved. So thinking about the benefit of our investee company on society, that has been tremendously exciting and rewarding, seeing how Moderna have been able to come up with a COVID vaccine in record-breaking time, and no doubt help to save hundreds of thousands of people's lives. That has been really exciting. Seeing how businesses that are transforming renewable energy and electric vehicles like Tesla, and making progress on all sorts of fronts that help to contribute towards a more sustainable future. That's been tremendously rewarding in 2021.
I can completely understand that, particularly with Moderna, saving people's lives, allowing us to live more normal lives, so important. I'd like to thank our managers very much for joining us today. It's great to hear their views on this year and the outlook for 2022. But I'd like to emphasize we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you are in any doubt, you should talk to a financial advisor. All that remains is for me to wish you a very Merry Christmas and a Happy New Year. Thanks so much for watching.